The first million takes most people 22 years to build. The second million arrives in 4. And the thing that makes that second one faster has almost nothing to do with compounding. It's something behavioral and structural that activates at that exact threshold and that almost nobody explains to you before you get there. I'm going to walk you through exactly what changes at $1 million invested, including the single mistake that quietly destroys more wealth at that precise moment than any market crash ever has. Not a generalized mistake. One specific, nameable, almost embarrassingly common mistake that the financial advice industry is uniquely incentivized to help you make. Most financial content gives you the surface answer. Compounding accelerates. Great, thank you. But nobody explains why the popular description of that acceleration is actually incomplete, that there's a psychological phase shift happening alongside the math, a tax dynamic that starts working in your favor in ways it literally couldn't before, and a behavioral trap that catches a remarkable percentage of newly minted investor millionaires right at the exact moment their wealth should be entering its fastest phase. These three things together explain why most people who hit $1 million in their portfolio don't experience the second million arriving in 4 years. They experience it arriving in 11. And the difference is almost entirely avoidable. So here is what this video covers: the actual math of what changes at 1 million and why the explanations you've heard are missing the most important parts. The one specific mistake, and I'll name it precisely, that slows everything down exactly when it should be accelerating. The psychological transformation that separates investors who double quickly from investors who sit on $1 million for a decade going sideways. And the tax layer that most investors don't discover until they've already left a substantial amount of money on the table. We're going to go through all of it. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use assumptions that Vanguard's and BlackRock's own models would never endorse. It uses their actual methodology to expose the weak points in your specific plan, and I only ask for your email to send the report because I don't store any of your financial data. Link is in the description. Now, before I get into the numbers, I want to give you an image, a flywheel, one of those enormous iron discs that old industrial factories used to regulate the output of steam engines. A flywheel is heavy. Getting it to move requires sustained, physical, unrewarded feeling effort. You push. Nothing seems to happen. You push again. The disc moves a fraction. You push every day for months, and the movement is still almost invisible. Then somewhere, and this is the important part, there's no single dramatic moment, no breakthrough, no milestone push. The disc reaches a speed where the energy you've built into it starts releasing on its own. And once a flywheel is spinning at speed, stopping it requires more effort than starting it did. That is your investment portfolio. $1 million is roughly the point where the disc stops needing you to push every day. Everything I'm going to tell you in this video lives inside that image. The reason most investors never experience the feeling of a spinning flywheel isn't that the flywheel doesn't work. It's that they grab it right when it starts moving. In a few minutes, I'm going to show you the specific psychological trap that catches investors right after the flywheel starts spinning, and I promise it's not what you'd expect. But first, let me show you why the math alone is already stranger than you've been told. Here's the number that anchors everything. The average 401k balance in America, according to Fidelity's most recent data as of late 2025, sits around $132,000. In a good year, a 10% return on that balance generates about $13,200. Not a bad year, not an extraordinary one. A normal, historically average year, $13,000. Now take a $1 million portfolio in that same year at that same return, $100,000. Same market, same 10%, same calendar year. The difference between those two numbers, 13,000 versus 100,000, is the entire argument for why the first million matters. Not as a trophy, not as a psychological milestone you're supposed to feel good about, as a mechanical threshold, a point after which the portfolio's own output starts dwarfing what you can contribute from a paycheck. The rule of 72 is the shortcut that makes this concrete. At 10% annual returns, money doubles every 7.2 years. At 7%, which is the number most serious financial planners use after accounting for inflation, money doubles every 10.3 years. Now run either of those doubling rates forward from $1 million and look at what happens. At 10%, 1 million becomes 2 million in 7 years, 4 million in 14 years, 8 million in 21 years. At 7% real returns, 1 million becomes 2 million in 10 years, 4 million in 20 years. Even in the more conservative scenario, the flywheel is doing things your paycheck never could. And here's the loss frame that matters. Every year you delay reaching that first million is not a year of lost returns. It's a year of lost acceleration. Those are not the same thing. And conflating them is how people underestimate how important the runway is. There's a story that illustrates the starting point problem perfectly. Back in the late 90s, a behavioral economist named Richard Thaler, who later won a Nobel Prize, ran a series of experiments on how people experience financial progress. One of his consistent findings was that investors systematically underestimate the impact of starting conditions on long-term outcomes. Participants who were given identical compounding scenarios but different starting amounts made wildly different investment decisions. The people who started with more didn't just end up with more. They made better decisions along the way because they could see the compounding working in real numbers. The people starting from near zero often abandoned their strategies before the math could demonstrate itself. They quit right before the discs started spinning. Thaler called this part of a larger framework around what he named mental accounting, the way humans assign subjective value to money based on context rather than mathematics. And one of the clearest expressions of that cognitive failure is investors giving up at $200,000 because the progress feels invisible, not understanding that they are a few years from the point where the flywheel starts doing the heavy lifting. Now, this is where it gets really interesting. In a few minutes, I'm going to introduce you to Marcus. Marcus is the clearest real-world illustration of the one mistake I mentioned in the first 30 seconds of this video. But first, here's what nobody is telling you about what happens in the financial services industry the moment your portfolio crosses $1 million. You get reclassified. You become a high net worth client. And that reclassification comes with a specific, well-intentioned, extensively documented, and quietly catastrophic change in the advice you receive. The language shifts from growth to wealth management. The recommended allocations shift toward conservative positioning. The pitch becomes, and I've heard versions of this sentence from multiple advisors, at your level, it's no longer about growth, it's about protecting what you've built. Protection from your own flywheel. Most financial advisors are held to a suitability standard, not a fiduciary one. Suitable investments for your risk profile, not necessarily optimal ones for your actual situation. And the moment you're classified as high net worth, the suitable recommendation almost universally becomes a 60-40 portfolio, 60% equities, 40% bonds. The 60-40 model has been a fixture of financial planning since the 1970s. It was designed for a different interest rate environment, for investors without decades of compounding runway ahead of them, and for a bond market that actually paid meaningful yields. For a 45-year-old with $1 million and 20 years before they need the money, a 60-40 allocation isn't protection. It is a controlled deceleration of the disk you spent 20 years spinning. Vanguard published research in 2023 looking at portfolio outcomes across rolling 30-year windows going back to 1926. Over those periods, a 100% equity portfolio outperformed a 60-40 in approximately 85% of scenarios. Not some of the time, 85% of the time. And in the scenarios where 60-40 won, the margin was narrow. In the scenarios where equities won, the margin was substantial. Let me put dollars on the difference. $1 million in a low-cost, 100% equity index strategy at 7% real returns over 20 years becomes approximately $3.8 million. $1 million in a 60-40 allocation at a blended 5% real return over the same 20 years becomes approximately $2.6 million. $1.2 million. Not lost to a crash, not lost to bad stock picks, lost to conservative positioning that felt responsible and was described as protection. Sometimes a financial advisor hands you a brochure that says wealth management on the cover. And what the brochure is actually managing is the rate at which your wealth stops compounding. We charge 1.2% to manage your $1 million. What do you get for that? Professional guidance. And what does professional guidance mean in practice? We rebalance quarterly and move you into more bonds. Incredible. Genuinely incredible. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. And this is the kind of math that will keep coming. Now, Marcus. Marcus hit $1 million in his 401k in late 2017. He was 48 years old. He'd been investing for 23 years, mostly in a target date fund and a plain S&P 500 index fund. Nothing clever, no stock picking. The flywheel had been spinning for 2 decades of quiet, unremarkable pushing, and it had finally reached real speed. He should have left it alone. But that year, he also received a separate inheritance, about $75,000 outside his retirement accounts. Not life-changing money in isolation, but enough to make him feel, for the first time, like someone with real money. And that feeling, that shift from person investing to person with real money is where the trouble started. He hired an advisor. The advisor ran Marcus through a risk tolerance questionnaire, determined he was a moderate investor with a preference for capital preservation, and placed him in a 60% equity, a 40% fixed income portfolio with a 1.2% annual management fee. Professional, reasonable, devastating. Between 2017 and 2024, the S&P 500 roughly doubled. Marcus's conservatively allocated, professionally managed portfolio grew by approximately 43% over that same period. His colleague Kevin, same age, same starting balance, different choice, did nothing but stay in his target date fund with an expense ratio of 0.1%. Kevin had $2.3 million by the end of 2024. Marcus had $1.4 million. The gap between them wasn't intelligence. It wasn't a different market. It wasn't luck. It was a flywheel. One of them let it spin. One of them hired someone to slow it down and called it wisdom. We'll come back to what Marcus did next, because his story doesn't end there, and how it resolves matters for what I'm about to tell you. Here's the thing though, and this is the reversal I want you to sit with for a second, because it sounds wrong until you really look at it. You think the problem Marcus had was his financial advisor. That's the obvious explanation. The advisor had the wrong incentives, recommended the wrong allocation, charged too much, and cost Marcus nearly $1 million in unrealized compounding. All of that is true, but that's the surface story. The actual explanation runs one level deeper, and it's significantly more uncomfortable. You think the problem is the advisor. Actually, the problem is what Marcus felt the moment he crossed $1 million. Because Marcus didn't hire that advisor because he was naive. He hired that advisor because $1 million triggered a specific, predictable, well-documented psychological response that made conservative positioning feel correct. The mistake wasn't the product of bad advice. The bad advice was the product of a psychological shift that happens to almost everyone at that threshold, and that the advice industry is perfectly positioned to monetize. Here's the behavioral economics. For the first 15 or 20 years of building a portfolio, most investors operate in a mental mode that's roughly calibrated to survival. Am I on track? Is this working? Will I be okay? That anxiety is uncomfortable, but it's actually functional. It keeps you focused, it keeps you consistent, and it makes every dollar feel real enough that you don't make cavalier decisions with it. Then you cross $1 million. The anxiety doesn't disappear, it transforms. The question shifts from, do I have enough, to how do I not lose this? And that shift, reasonable as it sounds, human as it is wired to push you toward exactly the wrong behaviors at exactly the wrong time. Kahneman and Tversky documented loss aversion in the 1970s. The psychological pain of losing a dollar is approximately twice the pleasure of gaining one. At a $100,000 portfolio, a 20% market drop is $20,000. Painful, but survivable. At $1 million portfolio, that same 20% drop is $200,000 on paper in a month. $200,000. That number hits different. And the brain, which is not a rational financial calculator, registers $200,000 disappearing as a crisis that requires a response, even when the rational response is doing absolutely nothing. So investors who are perfectly disciplined and emotionally stable at $300,000 become erratic and reactive at 1 million. They start checking prices every day. They start engaging with financial media they would have ignored 6 months earlier. They move some money to cash temporarily until things settle down. And in doing so, they introduce exactly the friction that stops the flywheel. The disc isn't stopped by a market crash. It's stopped by your hand. The investors who navigate this successfully share one habit. They reframe what the portfolio number means. They stop reading it as money I have and start reading it as money that is working. Money you have can be taken from you. Money that is working is already doing something. It's not sitting there waiting to be lost. It's in motion. When it drops temporarily, it's fluctuating within a process, not being taken. This is not a motivational reframe. It's a cognitive security system you install when you're calm so that it runs automatically when you're not. I know a guy, and this is not me, because I made a different set of mistakes at different portfolio levels, who hit $1 million in early 2020 and immediately moved roughly 300,000 of it to cash. His exact phrase was dry powder. He was going to deploy it on the next significant dip. The dip came in early 2022. The market dropped meaningfully. He did not buy, too uncertain. The market recovered through 2022 and 2023. He still did not buy. Don't want to catch a falling knife. Then it hit new highs in 2024. He absolutely was not going to buy at new highs. 2 years later, he ran the math. That $300,000 in cash had lost roughly 14% of its real purchasing power to inflation. Meanwhile, the invested $700,000 had grown substantially. He did not have dry powder, he had wet powder. He had expensive, inflation-eroded, opportunity cost-laden wet powder. The flywheel was spinning. He'd been standing next to it, holding a bucket of water. Now here's what nobody is telling you about what comes after you survive the psychological trap. Because once you've kept the flywheel spinning past 1 million, the nature of the game changes in a way that's genuinely new. And most financial content doesn't go here because it requires explaining tax mechanics, which are less exciting than market predictions. Let me give you the 3 levels framework, because this structures the rest of what I'm going to tell you. Level 1, accumulation mode. Your portfolio is below roughly $300,000. Your contributions are the dominant variable. A 10% market return on $100,000 is $10,000. Nice. But your monthly $2,000 contribution matters more than almost anything the market does. You are the primary engine. You are doing most of the pushing on the flywheel. Level 2 copilot mode. Portfolio somewhere between 300,000 and 1 million. Your contributions and your returns are roughly equal partners. A 10% year on 500,000 generates $50,000. Now we're talking real money alongside your contributions. You and the flywheel are sharing the load. Level 3 flywheel mode, above 1 million. The portfolio's own output begins to dominate. A 10% year on 1.5 million generates $150,000. Your annual contribution might be 30 or 40,000. The flywheel is doing 4 times the work you are. And this completely changes what your smartest next dollar should be doing. At level 1, the highest value action is maximizing your contribution rate. Save more, spend less, invest the difference, stay in low-cost index funds. That covers 90% of it. At level 3, the highest value action is not your next contribution. It's removing friction from the spinning flywheel. Lower fees, better tax positioning, fewer emotional decisions. Every point of friction you remove adds to the speed of the disc. Here is where the numbers get genuinely uncomfortable. A 1% annual management fee on a $1 million portfolio is $10,000 per year in explicit cost. But that's not the actual cost, because that $10,000 isn't just gone, it's removed from your compounding base. Every dollar that leaves your portfolio as a fee is $5 to $10 you will never see at retirement. A 1% fee on a $1 million portfolio over 20 years at 7% baseline returns doesn't cost you $200,000. it costs you closer to $430,000 in foregone compounding. That's not a rounding error. That's a number that should make you look up your expense ratios tonight. The Spiva Report S&P Index versus Active tracks the performance of active fund managers against their benchmark indices and publishes the results annually. Over 15-year periods, consistently, approximately 88 to 92% of active fund managers underperform their benchmark index after fees, not some years. Consistently, in any given 15-year window you choose. Which means if you are paying someone 1% per year to actively manage your investments, you have roughly a 10% chance of that arrangement being worth the cost. Those are not odds you'd accept in any other domain of your financial life. Asset location is the second piece of friction removal, and it's one of the most underused tools available to investors who have money in both taxable and tax-advantaged accounts. The insight is simple. Your 401k and IRA shelter income from taxes right now. So the assets that generate the most taxable income bonds, REITs, high dividend ETFs, should live inside those accounts. They compound there without annual tax drag. Your taxable brokerage account should hold your most tax-efficient investments, total market index funds, growth-oriented ETFs, anything that grows primarily through price appreciation rather than distributed income. You don't pay capital gains until you sell. You can control when you sell. You cannot control when a bond fund distributes interest. This single organizational adjustment, moving the right assets to the right accounts without changing a single investment, can add the equivalent of 0.4 to 0.8% per year to your effective after-tax return. That number sounds small. On a $1 million portfolio over 20 years, it's the difference between $3.8 million and $3.3 million. Tax loss harvesting is the third tool, and it's the one that starts generating serious dollar amounts once your portfolio reaches significant size. The mechanics. When a holding is temporarily down in value, you sell it, claim the paper loss for tax purposes, and immediately replace it with a similar but not identical investment to maintain your market exposure. You've changed nothing about your investment thesis. You've reset your cost basis lower and generated a tax loss you can use to offset realized gains elsewhere, or up to $3,000 of ordinary income per year with excess carrying forward indefinitely. At a $50,000 portfolio, this generates marginal value. At a $1 million portfolio in a volatile year, you might harvest $30,000 to $60,000 in paper losses. At a federal capital gains rate of 15 to 20% for most investors, that's $4,500 to $12,000 in actual, real, cash equivalent tax savings. Every year you do this, without changing your investment strategy at all, without timing the market, without taking on additional risk. It is money that stays in the flywheel instead of leaving it. Now Marcus comes back. 2022. Marcus has been watching Kevin's portfolio from a distance, the way you watch someone else's flywheel spinning from across the factory floor. He starts doing math he probably should have done in 2017. He calculates what his 1.2% fee has cost him in compounding terms over 5 years. The number is not comfortable. He pulls the Vanguard white paper on long-term equity versus balanced portfolio performance. He reads it. He starts asking his advisor specific questions. What is the expense ratio of each holding? What is the tax efficiency of the portfolio? What would the allocation look like if he were 15 years younger? The advisor handles some of these questions well, not all of them. And that gap between the questions and the answers is where something changes. By 2023, Marcus is working with a fee-only advisor. Not fee-based, fee-only. The distinction matters enormously. A fee-only advisor charges a flat retainer or hourly rate for advice. They do not receive a percentage of your assets, so they have no financial incentive to manage more of your money or keep you in expensive products. Structurally different incentive, his allocation is now 80% equities, 20% fixed income, not all the way back to 100%. At 53, he's thought about sequence of returns risk, which is real and worth addressing, but 80%. And he handles tax loss harvesting himself through his brokerage's built-in tools, which takes him about 45 minutes in November each year. His portfolio as of early 2026 is approximately $1.9 million. He is not back where Kevin is. Kevin is at about $2.5 million now. The gap created between 2017 and 2022 is not fully recoverable. Compounding lost is more expensive than compounding deferred because the lost compounding would itself have compounded. But Marcus's flywheel is spinning again at its natural speed. And at his current trajectory, he hits 2 million within the next year or two. He learned an expensive lesson. He learned it in time to matter. There's a broader point in Marcus's story that I think is the most important thing in this entire video, and also the thing least likely to appear in conventional financial content. Marcus didn't lose ground because his advisor was malicious. He lost ground because the people around him had incentive structures that were subtly misaligned with his own, and he didn't see that until the math had already done its damage. The advisor was doing exactly what the advisor was trained, incentivized, and legally permitted to do. The system worked perfectly. It worked exactly as designed. It worked for everyone except Marcus. This is the systems thinking lens that changes everything once you cross $1 million. It is no longer enough to make good investment decisions. You have to understand who benefits from your financial decisions besides you. Every fee you pay benefits someone. Every complex product you're sold benefits someone. Every conversation that steers you toward conservative wealth preservation at 48 benefits someone. You have to be the person who runs the math and asks specifically and without sentimentality, what would I have if I just let the flywheel keep spinning? Let me put all of this into one concrete scenario. Take someone I'll call Daniel, 42 years old, been investing since he was 26, mostly through his employer's 401k and a Roth IRA he maxes every year. Current portfolio is $800,000, a mix of a target date fund in the 401k, with an expense ratio of 0.15% and a total market index fund in the Roth at 0.03%. He puts in about $2,500 a month across both accounts. His blended annualized return over 16 years has been approximately 9.4%. Nothing exotic, boring, grinding, relentless consistency. At that contribution rate and that return, Daniel's portfolio hits $1 million in roughly 22 months. Not 7 years, not a decade of grinding from 800,000, 22 months. The flywheel is already doing most of the work. His contributions are accelerating the timeline, but even with zero new contributions, at 9.4%, his 800,000 hits 1 million in about 26 months. Daniel's a few months from the threshold. Here's the question for Daniel. What does he do the day he hits 1 million? If the answer is nothing, I keep doing exactly what I've been doing for 16 years. Daniel reaches $2 million somewhere around age 51 or 52 with continued contributions. He doesn't need to be clever. He needs to avoid being clever in the wrong direction. The temptation at 1 million is always to do something different, to optimize, to hire someone who makes the strategy feel more sophisticated and therefore more worthy of the number. Daniel needs to resist that temptation with everything he has. The flywheel doesn't reward complexity. It rewards the absence of friction. So here are the 3 specific, non-generic, mechanically actionable things to do at the 1 million threshold. First, audit every fund you own and calculate the weighted average expense ratio of your total portfolio. Write it down. If it is above 0.2%, you're paying too much. If it is above 0.5, you are paying significantly too much. If it is above 1%, you are paying someone to underperform a free index fund at a scale that, compounded over 20 years, will cost you hundreds of thousands of dollars. The fix is boring and available right now. Vanguard, Fidelity, and Schwab all offer total market index funds at under 0.05% expense ratio. Moving to them requires no financial sophistication. It requires reading a fund comparison and clicking a button. Second, write an investment policy statement. 1 page, not for a financial advisor, for your future panicking self. Write down your target allocation, your rebalancing trigger, and specifically what market conditions would or would not cause you to make a change to your strategy. I will not change my allocation in response to any market drop under 40%. I will not move assets to cash for more than 30 days. I will not sell index fund positions to buy individual stocks or alternative assets. Seal it. Put it somewhere you'll see it in a market crisis. Because the only thing that stands between you and a terrible decision in a falling market is a piece of paper you wrote when your cortisol was normal. Third, run a tax location audit. List every asset you own and where it lives. Anything generating significant ordinary income bond funds, dividend-heavy ETFs, REITs, should be moved inside your 401k or IRA if possible. Anything growing primarily through price appreciation should be in your taxable account. Then put a 45-minute appointment on your calendar every November to review tax loss harvesting opportunities. These three actions together, expense ratio, reduction, written policy statement, tax location, are not exciting. They do not make good content. They are not the kind of thing anyone is going to tweet about. They will probably add somewhere between $50,000 and $150,000 to your 20-year outcome. That's what unglamorous friction removal looks like when it compounds. The arc of all of this is actually very simple, even though the mechanics are granular. For the first decade or two of investing, you are the flywheel's engine. You push it through periods where nothing appears to be happening. You push it through corrections that feel like the end of the strategy. You push it through years where your neighbor made 400% on something and your portfolio went up 8% and it felt like you were losing a race you weren't even in. All of that pushing builds mass in the disc. Then something crosses a number, a threshold, a point where the disc has enough mass and enough velocity to start generating its own momentum. And the entire job description changes. You stop being the engine and start being the engineer. Your function is no longer to push harder. Your function is to remove everything that creates drag. The tragedy of the people who don't experience this, and there are many of them, because the average 401k balance in this country is $132,000, and most people will retire nowhere near 1 million. Isn't that the flywheel didn't exist for? Them. It's that they stopped pushing. They stopped at 200,000 because the progress felt invisible. They panic sold in 2020 and missed the recovery. They put dry powder in a savings account and watched it erode. They hired someone to slow their disc down and called it wealth management. They quit the race they were already winning, usually within a few years of the point where compounding would have started doing the work for them. Warren Buffett earned more than 97% of his net worth after his 50th birthday. Not because he became smarter at 50, not because he discovered some new strategy, because a flywheel he had been pushing since he was 11 years old had enough mass and velocity by then that the numbers stopped being comprehensible to ordinary arithmetic. The push was the same. The disc was enormous. And critically, and this is the part of the Buffett story that almost nobody emphasizes, he never grabbed the disc. Through the crash of '87, through the dot-com collapse, through 2008, through 2020, he never grabbed the disc. You don't need his IQ. You don't need his 50-year runway. You need a low-cost index fund, consistent contributions, enough time, and the specific, practiced, sometimes difficult discipline not to reach into the flywheel when it finally starts moving. Lazy investing built more fortune than crypto memes. And I mean that in the most literal sense possible. The investors who outperformed the vast majority of active traders, hedge fund managers, and market timers over the last 30 years were doing almost nothing. Buying boring funds, ignoring financial media, not doing very much, being aggressively, deliberately lazy with a strategy that needed no refinement, while everyone else was churning portfolios and chasing the next thing and paying advisors and watching tickers. The lazy investors were sitting very still and letting their flywheels spin. Marcus almost got this wrong permanently. Some of you watching this are about to make his mistake. Some of you are already in the middle of it. Here's the good news. The flywheel is forgiving. You can stop pushing for a while and it will still be spinning when you come back. What you cannot do is reach in and slow it down every time the speed makes you nervous. That's the only move that actually costs you everything. The first million takes 22 years. Don't spend the next 5 years managing it back to 1 million.